What if I told you the biggest investing mistakes of 2025 are not about picking the wrong stocks, but about the decisions people are not making right now? And I cannot tell you how many people regret not investing earlier, guys in their 50s and 60s or gals telling me, man, if I only started sooner. But people today are still making the same mistakes. And the question is, what happens when you realize you don't have enough money invested because of the poor decisions that you're making today? And that's the trap most people fall into without even realizing it. So, let me show you the five biggest mistakes investors are making in 2025, and you may be one of them. Let's start with the first one: avoiding investment decisions because of economic uncertainty. And here's the thing: you can always find a reason not to invest. You can pick up a paper or turn on the news any day of the week, and you're going to read about something bad. It's a guarantee. It could be high inflation, tariff concerns, the labor market, an election, a war, or policy changes. And these things can sound scary, and they are designed to make you feel uncertain and make you want to pull your money out of the market. But here's what most people forget: uncertainty is constant. Recessions, elections, wars, policy changes, and interest rate changes are all a normal part of the financial cycle. They have been and they will be again. The truth is, the stock market does not always translate into economic concerns or vice versa. The stock market is forward looking, and it's built to anticipate and adapt. Trying to time your investments based on the latest headline is a recipe for disaster. And if you wait for the perfect time to invest, you'll never do it. And that brings us to the next mistake. And that mistake number two is that you're always expecting the market to crash. And I get it. If you have been through market crashes, you're conditioned to think another one is right around the corner. And that's perfectly normal. And people are wired to think that way. But market corrections happen all the time. And since 2000, we have seen several pullbacks where stocks dropped at least 10% from a recent peak. And some of the most notable ones came in 2010, 2011, 2015 to 2016, 2018, and 2023. And even in 2025, at the time I'm recording this video, we've already had one correction earlier this year, and it's part of the cycle, and that's normal. Now, a bear market is when things get really tough, and that's a drop of 20% or more. And since 2000, we've had a few big ones, and there was the dot-com crash in the early 2000s, the great financial crisis in 2008 to 2009, and don't forget about 2022 when rising interest rates and inflation pushed the market down far enough to officially count as a bear market. Now, here's a chart from Fidelity that shows just how frequent these pullbacks are, and it tracks the S&P 500 index from 1985 to 2025 and highlights the impact of different economic and global events over time. And while there have been plenty of sharp downturns along the way, the bigger picture is clear. The long-term trend has been steady growth. And historical moments such as the collapse of the USSR, the Gulf War, 9/11, Brexit, and the COVID-19 pandemic all triggered volatility. Yet the index consistently recovered and pushed to new highs. The point isn't to deny that they happen, but to understand what they are. And when the market corrects or goes through a crash, you're not losing money if you don't sell, and you're actually buying stocks at a discount. It's an opportunity to buy the world's best companies at a lower price. But most people panic and pull their money out, missing out on the rebound, which is where the real money is made. And that brings me to the third mistake, which is waiting for cheaper share prices. And this one drives me nuts. And people say, well, I'll invest once the market cools down. It's too expensive right now. And guess what? They have been saying that for years. And this is exactly what I mean. The US stocks have delivered strong returns over 60% just in the past 3 years, leading some investors to worry the market is overvalued. And while valuations like forward PE ratios are above historical averages, research shows they are not reliable for timing the market. High valuations may lead to more modest but still positive future returns, often better than bonds or cash. Rather than selling out, investors should focus on diversification, including international markets or maybe smaller US stocks that may offer better value. Let me give you an example. When I started my own fire journey in 2015, I remember people telling me the same thing, and they would say something like the S&P 500 is too expensive. Just wait, it's bound to come down. Well, the S&P 500 ETF, or ticker symbol VOO, that I just started investing in was around $187 per share at the time. And people told me that $187 was too high because we may face another recession. Well, that recession did not come for another 5 years, and the VOO share price now is approaching $600 per share. But on paper, some people may argue with me that they were right about 2015 because 2015 looked like a promising year for the market. But in reality, it was a roller coaster. The S&P 500 started out strong, then it hit a wall mid-year with all kinds of worries, slowing global growth, oil prices tanking, and the Federal Reserve getting ready to hike rates for the first time in almost a decade. And just when investors thought things could not get shakier, China surprised everyone with a currency devaluation in August, and the market went nuts. By the time the dust settled, the S&P 500 had basically gone nowhere for the year. Flat, zero growth. A perfect example that even in a long bull run, you are going to get those stall years where patience gets tested. But because I continue to dollar cost average my contributions, I always bought into the market. When the market started to climb in 2016, I made a 12% return that year. And 2017 was a monster year with a 21% return. 2018 was a tough year with a loss of 6% due to the market uncertainty with China trades and the Federal Reserve raising interest rates out of nowhere. But if I had pulled the money out during the tough times, I would have missed out on the 31% gain in 2019, the 18% gain in 2020, and another 28% gain in 2021. The lesson learned for many investors is to always stay in the market. The fourth mistake is a big one, and that is holding too much in cash or CDs. And I see this a lot, especially with people nearing their retirement age. They feel safer keeping their money in cash, CDs, or treasuries. And look, I get it. Those things feel secure. But here's the problem. You're trading long-term growth for short-term comfort. And according to Fidelity's research, people who keep too much in cash miss out on the much higher returns the stock market has historically provided. When it comes to how much cash you need in retirement, you need to know your annual expenses. Cash is for short-term needs, and if you put too much into it, you're going to end up facing an opportunity risk and as well as the inflation risk. And take a look at this chart. If you had put $100 into the S&P 500 back in 1980, it would have grown to about $17,000 by 2024. And the same $100 in bonds would be worth about $1,778. In treasuries, just $694. And if you only kept up with inflation, about $413. The chart says it all. Stocks are more volatile in the short run, sure, but over time, they have massively outperformed. For anyone with time on their side, staying too heavy in short-term investments can mean missing out on real growth. But it's important to point out that CDs and treasuries have their place, and no doubt they're great for stability. Just to be clear, a CD is basically a fixed deposit with a guaranteed return, usually just a few percent, while treasuries are government bonds, super safe, but again with a lower return. So here's how I recommend thinking about it. Everyone should have at least 6 months of expenses in an emergency fund, preferably in a high yield savings account. And that's your cushion. And if you're retired and you've got a pension coming in, it makes sense to hold another 6 months of expenses, maybe in CDs or treasuries for extra stability. And if you're planning on early retirement, I would even say keeping 18 to 24 months of expenses in those safe assets would make sense. And that way you've got cash to ride out a downturn without having to sell stocks at a loss. But anything more than that, and you're losing money to opportunity cost, you need to know your expenses or you will lose money in the long run to inflation. And the fifth mistake is trading your retirement investments like a brokerage account. And your 401k, your Roth IRA, and any other retirement investment vehicles you have are not meant to be traded like stocks. They are long-term accounts designed to grow over decades. They're not for day trading. The way to succeed with these accounts is to set a strategic allocation and stick to it. You don't get in and out based on the latest news. You do not move everything into cash because you're scared of a dip. You stick to the plan. Now, if you need to reallocate, it needs to be for a good reason and not because of fear. A good reason would be getting closer to retirement and wanting to move money into less risky funds. A bad reason would be moving your money out because the news said there's a recession coming. I have never traded on my 401k account, even with a self-directed brokerage account, with the 401k that came with it. And I have never traded on my Roth IRA or HSA because those are meant to be left alone until I'm in my retirement age. And the truth is, the biggest mistakes are not about what the market does, but they're about what we do. They're about letting fear and uncertainty paralyze us, waiting for a perfect moment that will never come, and holding on to cash that's losing value every single day. And I've heard too many stories of what if to not be concerned. And because these are not just financial missteps, they are missed opportunities for the future you deserve. It's about more than money, and it's about your peace of mind and the legacy you're building. The most important choice you can make is to stop letting these common pitfalls dictate your financial independence path. Take control, stay disciplined, and have faith in the long game, because the market will always recover, but time is something you can never get back. Stay in the market, don't time the market. Get your free resources at firesidechat.com/resources. And this has been another piece of a video, and I hope you got a lot out of it.